afternoon and welcome to BizTech Asian Midday Market Watch. I'm Samantha Voon, and let's start by taking a look at the market actions. So the Asian markets got mixed signals from mostly negative sessions on Wall Street. We have major tech stocks in US kept falling after some disappointing earning reports, but the losses seem to be slowing down now. So we had stronger than expected US GDP data for the second quarter, and that provided some positive news. So investors are also closely watching the upcoming PCE price index data, which is the Fed's preferred inflation gauge for clues of future interest rate cuts. Over in China, the Shanghai Composite Index fell 0.26%. And staying at 5-month lows. So the Chinese stock continued to underperform compared to other Asian stock markets. Even with the suppressed interest rate cuts by the PBOC, it did little to avail. Over in Hong Kong, the Hang Seng is up 0.08%. And in Taiwan, the chipmaker TSMC was an exception in the tech sector, where the company shares in Taipei fell nearly 7%. After a 2-day holiday in Taiwan due to a typhoon. So we have the Australia ASX 200 and the India Nifty 50 being Asia's top performer in the week, benefiting from investment flows into more economically sensitive sectors as investors anticipate lower interest rates for the year. In Singapore, the STI is down 0.12%. In Kuala Lumpur, it is also down 0.12%. In Japan, the Nikkei 225 increased by is down 0.02%, slightly recovering from earlier losses in the week. So Japan's stock markets were the worst performer in Asia this week. We have uncertainties before the Bank of Japan's meeting next week, adding to the selling pressure. The CPI data for Tokyo showed a sharp drop in underlying inflation in July, which could limit the PBOJ's ability to raise interest rates. Markets are divided on whether the BOJ will raise interest rates by 10 basis points next week. Over in Korea, the Kospi is up 0.59%. Overall, Asian stocks mostly rose as tech shares stabilized after several days of declines. And that's all I have for market updates. And to give insights, we have our guest, Kelvin Wong, Senior Analyst at Oanda in Singapore. Kelvin, welcome to the show.
Hi, thank you for inviting me back again, and happy Friday, Samantha.
Happy Friday, Kelvin. So we had the latest Tokyo CPI data this morning. How has that impacted the dollar-yen pair?
Sure. So if we dissect into the Tokyo CPI data, so what we have over here is that we do see a mixed bag of data if we were to put into that two separate component. So if we were to look at the component of core CPI, that's only excluding fresh food, that actually came in rather positive. It rose to 2.2% year-on-year from 2.1% year-on-year in June. So keeping much of more of a stabilization pace, I would say, above that 2% target that BOJ intended to have for the inflation target in Japan. But however, if we strip out the energy prices, that means we talk about the core CPI component. So the core CPI component is much more of a preferred metrics that the Bank of Japan used to actually analyze the inflation trend in Japan. So after stripping out the energy price, including fresh food, they actually grew at a slower pace of 1.5% year-on-year in June versus 1.8% it actually grew 1.5% year-on-year in July from 1.8% year-on-year in June. So with that mixed bag of inflationary metrics data out from the leading Tokyo CPI data, potentially from a very short-term perspective basis, we could see a bit of recovery in the dollar-yen. And if you look at it from a technical analysis perspective, the dollar-yen has really fallen by a fair bit since the start of this week. So we see a tremendous plunge in the dollar against the yen, which is the yen strengthening, and as well as the yen also strengthening across the board other major currency pair like the euro, the Aussie, the Kiwi, the sterling, the Canada dollar as well. And what we could see here very interestingly, there's some form of stabilization since late US session yesterday, right above the psychological level of 152/15170 near-term key support level. So if this support level continues to hold today, right into after the US PCE data release, that we could discuss more about that later, potentially we could see some form of short-term rebound taking shape back into the dollar yen picture. And given the fact that this mixed bag of Tokyo CPI data, it will lower the odds of a potential interest rate hike by Bank of Japan next week.
So let's talk about the current US stock market after the sell-off. Yeah, you touched on this earlier. Maybe you can share more about that.
Sure. So very interesting movement on the US stock market that has taken shape this week. So initially, before this sell-off that has taken shape this week, we do see some signs of rotation play back into the market. That means funds that are actually moving away from the mega cap technology stocks ahead of their earnings announcement for this quarter. So that's actually way before a Tuesday announcement of Tesla and as well as Google Alphabet. So we see outperformance in the Dow Jones Industrial Average, outperformance in the Russell 2000. All these are actually being driven by this yield curve bull steepening play that is in play. So what is this bull steepening about? It's just basically actually related to this higher odds that market participants have started to price in for an immediate start of a US Federal Reserve interest rate cut cycle that is very likely to kickstart in the September FOMC meeting. And after that, market has started to price in a slew of 25 basis point cut thereafter next. So that actually will lead to that US 2-year Treasury yield falling at a faster pace compared to the US 10-year Treasury yield. So that actually indicate to us of this bull steepening taking shape into play. So with this bull steepening taking shape into play, market will tend to focus away more for the laggards that could actually benefit from a slower, I would say, put away that lower debt burden due to the lower interest rate cost in the shorter term. So that actually benefit the Russell 2000 because the Russell 2000 company do have a, we call it lower credit standing as compared to the mega cap stocks. That means, i.e., when they decide to actually negotiate credit terms, or even getting a loan from the bank, they're actually more on a shorter term basis because they could not actually afford to have a higher term loan tenure, which have a higher cost, interest rate cost. And given their balance sheet are more skewed towards lower financing or lower tenure of debt, any lower cost of interest rate that's been driven by the interest rate cut cycle by the Fed could potentially improve this profit margin of the Russell 2000. So that should explain the outperformance that's taking shape since 1.5 weeks ago. Then how about the Dow Jones Industrial Average, which is much more concentrated on value-oriented play like the financials. So financials do also benefit from this bull steepening of the yield curve. Why? Because banks do actually borrow short-term and lend out long-term. So that could actually improve their net interest margin as well. So now the key story over here is that on on Wednesday, we do see across the board sell-off. Why? Because there was actually a tremendous decline on the Nasdaq 200 that causes a negative feedback loop back into the Russell 2000 and the Dow Jones Industrial Average as well. So yes, they do fall, but they fall at a slower pace. But net, they all fall at the same time, which is negative. So there's no some form of defensive element that has that's able to actually help on that intraday, we call it a Wednesday, or I would say performance on the US stock market. So what we could see over here is that as long as this healthy rotation take place, that means, i.e., the Nasdaq 100 or the S&P 500, especially the Nasdaq 100, why? Because they are heavily weighted on the mega cap stocks. They do not see a kind of very drastic sell-off that what we see on this Wednesday. We could see continue of this kind of healthy rotation into play. That means, i.e., we see a bit of sideways movement or a bit of underperformance like what we see yesterday on the Nasdaq and the S&P 500, while the Dow Jones and the Russell 2000 continue to help up positive gains. So, but that is providing that we don't see that kind of drastic sell-off that has taken shape on Wednesday on the mega cap stocks.
So, just a question here, Kelvin. Do you see money flowing back into tech stock anytime soon?
Yeah. So the thing about tech stocks right now over here is that market participants right now have started to question the current put away that high valuation or overly optimistic earnings growth that is being pegged to that, right? More likely driven by AI. AI is part of the story. And right now, can they able to actually continue to beat such rosy expectation that's being have on them? So what we could see is the evidence is that Google, yes, they do beat earnings expectation on a whole basis, but if you break down according to their various business segment, some of the business segment actually didn't fare as well, especially on the YouTube side of the business. So market will be scrutinizing other big tech earning release, which will be next week. So next week we see a slew of big tech earnings from Amazon, from Apple, from Meta, and the all important Nvidia will be out later at the end of this month. But nevertheless, from Apple, Meta, Apple, Meta, which is Facebook, as well as Amazon, we could actually see a gauge about how well they're able to perform in line with this high expectation that's being priced on them. So if they start to actually see actual earnings growth starts to actually temper off, that means it does not actually come in within the high expectation, we could actually potentially see this kind of, we call it profit taking coming into play on the mega cap stocks. So as long as this profit taking didn't actually shape a kind of very drastic sell off that what we witnessed earlier on Wednesday, we could see the healthy rotation back into the other part of the US stock market, which is the Dow Jones and the Russell 2000 components that could actually benefit from this profit taking from the mega cap stocks that's really rallied by a fair bit since the start of this year, and in fact in the last 2 years.
So I guess we'll just have to talk about this next week again, Kelvin.
Sure.
So before we end the show, I just want to touch a bit on what you mentioned just now, which is the PCE inflation data. Maybe
Yes.
you can share with us what
Yes,
is your
precisely.
outlook on that.
Yeah, precisely. So if you look at the current market expectation right now, it's more or less within my outlook as well. So market is just expecting a continuation of deceleration inflationary trend in US. Look at the core PCE data that is excluding fresh food and energy. So previous month, in the month of May, we are actually looking at this 2.6% year-on-year increase for May. But this time around, market expecting another push now to 2.5% year-on-year. So if it comes in market expecting and with my expectation as well, we see the slowest inflationary core PCE growth in US in almost 3 years. Okay, in almost 3 years. So that actually could actually further cement the start of the interest rate cut cycle in the US economy by the Fed in the September FOMC meeting. So that more or less already been priced into the picture. So now market is actually more concerned about the actual number that turns out later on. So let's say if it turns out at 2.4% or 2.3%, that's way below expectation, which is showing a much more steeper deceleration inflation trend in US. That could actually also support overall, we call it kind of a weakness in the dollar against the other major currency, especially against currency that has fallen by a fair bit, like the Aussie and the Kiwi. And that could actually some severe mean reversion taking shape. But however, if we start to see the inflation number suddenly starts to tick up because there is nobody expecting, that means we're talking about a rate about back to 2.78%, 2.7%, 2.8% year-on-year for the core PCE data, then that could actually reduce the odds of the US Federal Reserve first interest rate cut in September, because right now market is pricing a high odds about above 90%. So if that scenario turns out, that's not what market is expecting, we'll see that odds greatly reduce, and that could see some form of dollar strength coming back into the picture again.
Okay, so all eyes will be on the PCA data later. So thank you so much, Kelvin. Thanks for coming on the show.
My pleasure.
So this has been BizTech Asian Midday Market Watch. Be sure to keep informed on the latest market updates weekdays on 1 p.m. I'm Samantha Voon, and this video and podcast will be on our website, www.biztech.asia, and our social media platforms. It will also be on our syndication partners' TV stations, radio stations, and website. Remember to like and subscribe. Thanks for tuning in.